So we are continuing today with capital structure theory and wanted to go over what is this whole idea of a balanced capital structure, of a capital structure that maximizes value. So the first idea is, how do we fund ourselves? Is it equity? Is it debt? And what is the cost of equity? And what is the cost of debt? So that's where you start. But if you look at this slide here, from an equity investment, if the initial investment is $1,000, you look at that, how do we value equity? As we saw last week, it's the projected cash flows. So if the equity is in a good state, you have higher projected cash flows. Bad state, lower. Average, a little bit more than the investment. And these are the returns. So for an all equity firm, this is kind of the idea of what is the expected cash flows. Now, if you have a firm that is funded by debt and equity, okay, then you have a different type of a projected cash flow, right? Because the debt is more secure, first of all, okay, and the expected returns can be a little bit different. So, um, in this case, we're actually looking at the same expected return, but okay, as you look and see, for example, with this one, purchased unlevered equity, savvy investors debt, homemade levered equity. So in other words, if you fund yourself with several sources of equity, several sources of debt, you can see based on the cash flows, the returns actually are different. So that's kind of what we're trying to look at and see here today. As you know from the DuPont's model, when you borrow and you have a good business going and you are producing, say, a certain return on equity, and you put debt into the equation and do more of the same, and given that it's successful, you can increase your returns with leverage. But the idea is, how far can you go increasing your returns without risking the risk of bankruptcy? And that's what we're talking about. This is what this whole week is all about: the cost of equity. In other words, as debt to equity ratio rises, the cost of equity also can increase. The cost of debt on the other side is much lower than equity usually, but as we near a higher debt to equity ratio, the cost of debt can increase, and that's the idea. Debt has become a very popular source of capital funding in recent years, and that's why debt issuances have skyrocketed. And you have to think of the advantages. Of course, the advantages, it simply is cheaper than equity, and it's easier to raise than equity. It's not tied to your valuation as much. And the credit monitoring is not as severe. It could be just sending in a few financial statements and forecasts and things like that as equity, being a public company. So there's different benefits and different advantages to debt. And of course, the idea is that not to have too much debt. That's where the risk comes in. And now if you follow what's going on with Tesla and the Wall Street Journal, there's more and more articles talking about how they do have, of course, they have various issues with risk management and governance, but there is a debt there that has gotten high, and this is a classic example of, potentially the equity valuation is suffering because of the debt level, and whether they will be able to climb out of it. So ultimately, this is what the theories talk about in terms of maximizing the firm value by finding this ideal leverage ratio, this ideal debt to equity ratio. And it's actually different for every industry. So some industries are very levered and some industries do better unlevered. And some investors like companies to optimize their capital structure, and some investors like Warren Buffett actually say, I want the company to have minimum debt. But in this week, go through the rest of the module of the Harvard Business School module and look through the different models. Try to identify and see to what extent does a certain debt level maximize the value of the firm, because that is really the theme of this topic.